In this lesson, we want to proceed our discussion or lesson on consolidation account or consolidated financial statement or group account preparation. We have already looked at most of the basic things in our previous lesson, and today we want to look at another pertinent, important concept that you will need in the consolidation process, and that is intra-group trading or intra-group transaction. Anytime you pick any consolidated financial statement question, or anytime you are trying to prepare consolidated financial statement account in your various institutions, you probably come across a situation where there will be an intra-group trading or intra-group transaction. In a few minutes, you will look at what is an intra-group trading or what is an intra-group transaction, and we look at how to go about each adjustment so that we may get the proper figures for our further computations. So in this lesson, we are just going to focus on that particular concept, which will also aid us in our consolidation process. Right. So intra-group trading. Now, what is intra-group trading or intra-group transaction? When we talk about intra-group trading or intra-group transaction, for the purpose of this lesson, let's use a parent and a subsidiary. You know, a group can have more than two entities comprising the group. That means we may have a parent and more than one subsidiaries. So here, for the purpose of this particular lesson, we are going to focus on a parent and a subsidiary, or the acquirer and then acquiree. Remember that anytime the acquirer obtained control or has purchased 50% or more equity shares or votes of the other entity, that particular acquisition gives control. We have a lesson on that particular topic already, so you can probably look at it for better understanding so that you can be at par with us over here. Now, when we talk about intra-group trading or intra-group transactions, we are saying that these two entities, although they are separate in nature, in their legal form they are separate, in terms of substance they are one economic entity. So although this parent or this entity has acquired this entity, and in a natural form they are separate entity, okay, but when it comes to group account, we see these two entities as one, as a single entity, and under normal circumstances trading among them should be seen as one. You cannot trade with yourself, or you cannot trade within yourself. You need someone to trade with. So if we have seen that P or a parent is trading with a subsidiary, or a subsidiary is trading with another subsidiary in the same group, then there is an issue over there. Then that trading needs an adjustment, or it needs an elimination. So at any point in time, you cannot trade with your own self. You need to trade with someone. So the trading must be with an entity outside the group, but not entities within the group. Anytime entities within the group trade among themselves, then we call it intra-group transaction. Intra-group transaction. And this intra-group transaction needs an adjustment depending on the type of transaction that has occurred between these entities in the same group. So in this lesson, we will take our time and look at all the intra-group transactions or trading that can exist or that can occur between two entities within the same group. So like I said earlier on, it is not possible to trade with your own self. And since we have looked at this as they are one economic entity, then there should not be anything like they trading with themselves. They should trade with an outside entity. So if you see in a question or you are preparing your consolidated financial statement in your entity, and then there is an issue of a trading among themselves, like sometimes P selling to X or giving loan to X, then we need an adjustment before we can proceed with the preparation of our consolidated financial statement. So our first type of intra-group trading or transaction that we'll be looking at is indebtedness or current account. Like I said, we have series of them, or we'll take them one by one. We have what we call trading of current assets like inventory among groups, which gives rise to unrealized profit, and also we have what we call trading of non-current assets among groups, which also give rise to maybe overcharge depreciation as well as unrealized profit on the transaction. And then we also do have what we are looking at currently, which is the indebtedness or current account, or sometimes you also have where the entities will give loan to another entity in the same group. So we'll take our time and look at all of them and see how their treatment is supposed to be. First, let's focus on how to deal with indebtedness or current account. Indebtedness or current account is when you'll be presented with the two separate financial statements, as we always have in our question, or when you're preparing the consolidated financial statement, you'll be given the parent you'll be given the parent separate financial statement and then the subsidiary separate financial statement. So assuming that in the parent separate financial statement there is an amount of money that is owing to the subsidiary, or the subsidiary owing to the parent entity. So for instance, let's say we have in the trade receivable, we have here to be 100 and here to be 500 in the separate financial statement. Then we have trade payable here to be 200 and here to be let's say 150 in the trade payable. This is a separate financial statement for P and X. I'm using this for the understanding sake. Assuming X is owing P, which is the subsidiary is owing the parent in this case, then in the trade receivable of the parent, this amount belongs to what? To X, or X is owing this amount. And when we come here, we are supposed to see the same 100 over here, because this is the amount X is owing to let's say P. So let's make this amount 50 over here. Let's make it 50 rather, not 150 over here. Now, so X is owing P and it has been reflected in the separate financial statement for the parent over here. So when we come to the trade payables as well, then we should see the same 100 over here. But as a result of intra-group indebtedness, that means X probably have paid the money, but it has not gotten to the parent as at the date they are preparing the consolidated or the separate financial statement, and therefore this amount will not reflect here, and there's the need for an adjustment. This situation is what we call cash in transit, or we have two of them, or goods in transit. So you have cash in transit or goods in transit. So the parent or the subsidiary, any of them owing the other, has paid the amount they are owing, or part of the amount they are owing, to the other parent, but that particular transaction has not been effected as at the date they have prepared their separate financial statement. So the balances in the separate financial statement will be different. Anytime that happens, then it gives rise to what we call cash in transit or goods in transit. So like I said earlier on, assuming that S is owing P, so it's in the receivable, so we know that we are going to receive an amount of 100 cedis from X. But this, when you come here, the amount should also be 100, but here it end up being what? Being 50. That means probably X has transferred 50, which has not gotten to P on the day they are preparing the account. And if that happens, there is a need for an adjustment. Now that we know what gives rise to cash in transit and then goods, it is the same thing pertaining to the inventories. Probably P may have transferred some inventory to X, but might have not gotten to S on the date on which they are preparing the account, and this gives rise to goods or inventories in transit. Now that we know what gives rise to all these two phenomenon, we want to look at how to treat them, including their journal entries. Now, anytime there is a cash in transit, that cash in transit, when you are preparing now, this is the separate financial statement. Let's assume this is going to be our group account over here. Our group account over here. Now, anytime there is a cash in transit, now when you come to the trade receivable, because we don't want to see the group trading among themselves, there shouldn't be anything as such where group will be trading among themselves. These figures must be eliminated, and then you will treat the cash as if it has been received. So what it means is that when your trade receivable should be, that 100 should go, so you have to less that 100. It shouldn't come at all, because in this case it's just the 100 over here. And then when you are preparing the trade payables, this 50 will not come at all, but this money, which is cash in transit, must be received. Let's say your cash should be the 50. You add it to your cash balance as if this money has actually been received, so that these two figures, the 50 can cancel the 100 over, so that it will be 50-50 to cancel it off from the books of the entity. So this is how intra-group trading is eliminated when it comes to current account or cash in transit. Now there are some times that the question will give you that they will give you the total trading receivable to be, let's say, $1,000 over here, and here, let's say, is $800 over here, and they've told you that in this, or included in this trade receivable, is an amount owned by X. So now, not all the total receivable is owned by a member of the group. That means some of them is owned by an outsider, therefore that particular figure is not affected. So in this case, for instance, let's say that the amount the subsidiary is owing is 200 and it is embedded in this value, but we're told that X has transferred 100, which has not gotten to P after the day they are preparing the account. That means here too, the balance here will now be 100, because it's supposed to be 200, but because they have transferred the 100, which is in cash in transit, this 100 has not gotten to P. How do you treat this when you are preparing your group account? When you are preparing your group account, you first bring your two figures together, because it's going to be 1,000 plus the 500, which is the trade receivable of this, and then you will less your 200, which is the intra-group balances that is S is owing to P. Now when it comes to trade payable, you are going to less, now is a balance of 100, because you have already sent 100, which has not been received by P. That's why this balance here is still 200. So in this case, when you come to the trade payable, it's going to be 200 plus the 800 for the subsidiary minus the 100 balance, which is still there. We have to eliminate them. These figures has to be eliminated when you are preparing the particular account. Now, what about the cash in transit? Remember, the cash in transit must be recorded as cash received. So this will be trade receivable, not cash. So it will be cash received of plus 100. Now you see something here. So this plus has cancelled the negative here. So it will be left with negative 100, negative 100, and this will cancel off together. You can see this is at the asset side, while this is at the equity and liability side. So they will cancel off, making it balance. So remember that it's not always the case that the total amount here or the total receivable here is the same total amount received or owed by the subsidiary. Probably part of it can be owed, and if that is the case, this is how you should go about its treatment. Sometimes the entities will give you a specific direction that cash in transit is treated separately in the parent books, or the subsidiaries will depend on who is owing who. If this is the case, then remember that there will be nothing here as cash received, because this will be treated separately in the parent financial statement, not in the group account. So depending on the requirement of the question and how you should treat this cash in transit or goods in transit. Now let's come to the goods in transit. Here is going to be an issue of inventory. So let's say that there is an inventory over here for both the parent, the separate financial statement, the parent, and then the subsidiary. Now, if there is any inventory in transit which has not been received by the entities at the end of their reporting period, then when you are preparing your group account, you have to bring in that inventory by debiting your inventory account or adding it up when you are preparing your group account. So any goods in transit or any inventory that is in transit which has not been received by the parent after the year end or at the reporting period end, that particular amount of inventory must be captured over here. So assuming that there is a goods in transit of worth 250, and then let's say the inventory for parent is 150, and then let's make a difference. So let's say 100 and then 20 over here, and then when you come here to the group account, your inventory is going to be the parent and the subsidiary, so it's going to be 100 plus 20 plus the one in transit, which is the 250 in transit. This gives us your inventory value to compute with. Probably there will be no balance already in in the financial statement of the separate entities for you to eliminate when it comes to the goods in transit, but you'll be informed that one has transferred goods to the other which has not been received. So we have assumed that it is what is received. So please, with the cash in transit, you may have a balance of owing, but because of the one that is in transit, the balances here will not be the same. But at any point in time, if there is no cash in transit among the two groups, then remember that whatever will be here will be the same here. So it will be 200 over here. So when we are lessing, you also less 200, and here so you less 200. That is in the case where there is no cash in transit. That means the balance here of the owing by X will be the same as the trade payables under the subsidiary. Remember that it's not always the case where X will be owing P. P can also owe X, depending on what the question or the situation is all about. So this is about indebtedness or current account, and this is how to deal with them appropriately. Okay, so we want to look at the next particular transaction that may occur between the parent and the subsidiary. So that is provision for unrealized profits. So first we'll look at the inventory one, which is very, very important, and then when you are done, we'll look at provision for unrealized profit, which will be non-current assets. So first our focus will be on the inventory. Now, anytime a parent sells to the subsidiary or the subsidiary sells to the parent, and then that particular good remain in the account of the entity at the end of the reporting period, then there is an issue of unrealized profit. What it means is that one of the member of a group, let's say the parent in this case, will sell to the subsidiary. So the parent is going to sell to the subsidiary at a profit. And remember that these two entities are in the same group and they are one entity, and therefore any transactions among them should not give rise to what? To profit. But when any of them is selling to an outsider, okay, and an outside entity, that is when they can make this profit. But if X sells to P or P sells to S, there should be nothing like what? Profit element on it. But anytime any of them sells to each other, or if we can have more than one subsidiary sells to each other in the group, and then that good remains in the entity at the end of the period, then there is an issue of unrealized profit that you are supposed to eliminate from the books at the end of the reporting period, or when you are preparing your group account. You have to eliminate it in the group. Now, for you to better understand this one, you have to understand what we call markup and then margin, because a profit element is added to the cost when we are preparing or when you want to establish your selling price. So basically we say that your selling price is basically your cost price plus your profit. So before you can get this selling price, you need the cost of the item plus your profit element. This profit element have several ways of calculating it. Either we use what we call a markup, or we use what we call a margin. Alright. Now remember that margin is computed on the selling price and markup is computed on the cost price or the cost of the item. So anytime a question is given to you and then they give you the opposite of each other, so let's say they have given you cost price but yet they gave you margin, then there's a need to change it to what? To markup. Again, if they give you selling price and then the percentage of profit given to you is a markup, which markup is calculated on the cost, then we need to change it to what? To margin before we can deal with it. So how do we do that? Change it. So first, let's look at how to change markup. So markup to margin. When we want to change markup to margin, we always add. Remember that markup is on cost, whilst margin is on selling price. So if you want to change, if you've been given selling price, yet they've given you markup, then you have to change this markup to margin before you can work on the selling price over here. So it's probably going to be given percentage. Anytime you change markup to margin, we add. In other words, whatever percentage you have here divided by 100 plus that particular percentage. whatever you get becomes the amount of what margin you are going to use to compute for your unrealized profit on the particular cost. Again, if you want to change from margin to markup, in this case, you've been given cost, but the percentage given to is in margin. Therefore, you need to change the margin to markup so that you can work on the what? On the cost. So since here we are adding probably the down here, we will less. So it's going to be markup over here. So it's going to be the percentage over here divided by 100 minus the particular percentage we are dealing with before we multiply it with the figure we are dealing with. There is another way of dealing with this, which is a bit complicated, so we don't go there. I'm coming to show you how to establish whether the value is a selling price or whether the value is what is a cost price. For the profit percentage, the question will always tell you whether it is a markup or a margin. It is for you to determine whether the amount involved is a markup or is a selling price, so that whether you need a change from one to the other or you can straight away compute it on it. So if you are lucky and then the value is a cost price, then they give you my markup, then there's no need to change. You just have to multiply it to get your unrealized profit on that particular transaction. Remember that the parent can sell to the subsidiary and the subsidiary can sell to the parent. Anytime such transaction occur, there is a way you should eliminate the unrealized profit on it. Now let's take it from this angle. Now if the parent sells to the subsidiary, now if the parent is the one making the profit on the sales, so the parent is selling to the subsidiary, so the parent is the one making the profit on the sale, and therefore the unrealized profit is in the books of the parent. And when you are preparing your group account, that particular unrealized profit does not affect the subsidiary, because the group is a separate entity. In fact, the parent is a separate entity which forms part of the group. So if parent sells to the subsidiary, there's no need for apportionment between the retained earnings and then the NCI holdings of the entity. The NCI holdings do not partake in the sharing of unrealized profit anytime the parent is the one selling to the subsidiary. The case is different if the subsidiary is the one selling to the parent. So if the subsidiary is the one selling to the parent, then the profit element is in the parent books. It's in the subsidiary's books, and therefore the parent will take part of the unrealized profit, while the NCI holdings will also take part of the unrealized profit. There will be apportionment over there using the percentage of acquisition or control held by the parent as well as the subsidiary in the question. What this means is that when the parent sells to the subsidiary, all the unrealized profit is borne by the parent. But if the subsidiary sells to the parent, then there is a need for apportionment. So when you are preparing your group retained earnings, the percentage of the unrealized profit will go to the parent, and then when you are preparing your NCI holdings, the percentage of the NCI multiplied by the unrealized profit will also go to the NCI. That is about the apportionment. Now let's look at how to identify whether the value in the question is a selling price or is a cost price. Remember that if the parent sells to the subsidiary, then the parent is the one making the profit. But if X was able to sell all the goods to an outsider, then there's no issue of unrealized profit. Unrealized profit issue arises when the goods sold to one of the members of the group still remains in the account at the end of the period. But in the case where they have been able to sell all the goods to an outsider, that means there is no unrealized profit. So unrealized profit arises when let's take when parent are sold to a subsidiary, and these goods, some of them still remains in the entity. Then the parent is the one making the profit. Now to the parent, if they tell you that the amount that was sold is the parent's amount, then that particular amount is the selling price, because we sell at the selling price. But if they inform you that the amount sold to the subsidiary, this cost X, you see, this cost X, if this cost X, then that amount is a cost price, not selling price. But if the amount costs the one selling the item, then it is going to be what? The selling price. This is how to differentiate between whether the amount in the question is going to be selling price or is going to be what? It's going to be the cost price. This is when you are supposed to look at who is selling to who. the person selling to the other will sell at the selling price, and the person buying is going to see that particular amount at the cost price. So for instance, if P is selling to X, then we say that the amount involved, if it is cut to P, that amount is selling price, but to X, that amount is what? Cost price. As for whether it is a margin or a markup will be stated in the question. So remember that if it is a cost to the one selling, then remember that, and you are given markup, you have to change it to margin before you can work on what? The selling price, by adding your percentage to 100 before you can deal with the unrealized profit in that regard. Remember that the subsidiary can also sell to the parent. So if the subsidiary is the one selling to the parent in this case, and then they said the amount cost to the subsidiary, then remember that the subsidiary will see that amount as selling price, while the parent will see that amount as what? As cost price. In most instances, the question will state who the which of the entities that the amount is costing to. So you have to look at who is selling to who. And remember that the person making the sales is the one that is going to bond the unrealized profit. So the unrealized profit is prepared or is calculated in respect of the person what? Selling to the other, because the person selling is the one making the what? Making the profit. Because the one who take the group or who buys the group will sell to an outsider, and of which there is no unrealized profit in that regard. So always be vigilant. And remember, like I'm reiterating this, that if the parent or the subsidiary sells to each other, the one making the sales will sell at what? As a selling price, and then the one buying will sell at the what? The cost price. So you have to determine who sells to who. So the person selling to the entity selling to the other entity will sell at a selling price. For instance, if P is the one selling to S in this case, the P is going to sell at what? Selling price, and you are given markup, you have to change it to margin before you can determine your realized profits. But if X is the one selling to P, then the amount X is going to sell to P is going to be at the selling price, and in the same vein, X is going to be the one to make the profit. So you are going to calculate the unrealized profit or determine the unrealized profit for the one making the sale, in the group. Now you know how to get the value of an unrealized profit. So remember, if the unrealized profit is given to you and is let's take this example. Let's say X sells to P at $100 with a markup of 20%. A markup. And then we are told that this amount costs P 100 cedis. This amount costs P 100 cedis. You see, X is selling to P, so X will sell at what? At a selling price, and then P will see this amount as what? As a cost price. We are told that this amount costs to P. So since they are saying that this amount costs to the buyer, then this value should be seen as a cost price. So immediately, to determine your profit element or your realized profit is going to be the 100 multiplied by 20%, because this percentage given to us was a markup, as stated earlier on, was a markup. The whole thing will be a different issue if, for instance, let's assume P sells to X. So P is the one making the profit, let's say 150 with a markup of 25%. Now we were told that this cost P, the P is the one selling to X, but it costs P. So this value here is a selling price over here. And then therefore we have to determine the realized profit. But this is given to us in the markup, and therefore we need to change it to a margin before we can deal with the selling price over here, because we are saying that the value here is cost P, but P is the one making the sale. So it's going to be the 150 over multiplied by 25% divided by 100 plus the 25 over here. This will give you the unrealized profit to be charged. So this is how to compute for the unrealized profit. Now let's look at the treatment. Anytime there is an issue of an unrealized profit, first of all, you have to remember it depends on who is selling to who. So if the P is selling to the subsidiary, remember that the unrealized profit is going to be borne by the parent, because there will be no apportionment. But if the subsidiary is the one selling to the parent, then here there is going to be an apportionment between the two groups. So whenever it is, let's assume it is the parent, then you probably debit the group retained earnings. You debit the group retained earnings, and then you will credit your unrealized provision for unrealized profit account. That is the first treatment. In other words, you take the money or you take the value to the group retained earnings and less it will be a value to be less from there, and this will be treated as an amount that is in the provision for unrealized profit account. Then when you go to the group retained earnings account, group statement of financial position, this is where the question is not demanding for P&L account, the income statement. If the question is demanding for an income statement account, then probably this one will be debited in the P&L account as an expense, because you will not probably prepare your group retained earnings like as established earlier on in our previous video. If the question is asked, you are asked to prepare the income statement, then remember that we don't need this group retained earnings, because this one is the same as your P&L account. But in the absence where the question asks you to prepare a group statement of financial position, and then the group retained earnings serve as what? For P&L account. In this case, if we are preparing the statement of financial position, then remember that your group retained earnings will be debited with the unrealized profit, and then when you come to the group account, the amount for the inventory, you have to less that particular unrealized profit from the amount of the inventory for you to get the correct inventory to deal with. So don't forget this treatment, that if there is any unrealized profit, remember to less it from the inventory as well as taking it to your group retained earnings. This is when the parent is selling to the subsidiary. But when the subsidiary sells to the parent, for lessing it for the inventory is the same, but when it comes here, it needs an apportionment. Part of it will go to the NCI using their percentage of holdings. So the percentage of holdings multiplied by the unrealized profit goes to the NCI, and then the percentage of holdings multiplied by the parent percentage goes to the group retained, and that is apportionment when subsidiary sells to what? To the parent. But when the parent sells to the subsidiary, parent born all the unrealized profit. So this is basically about the unrealized profit on inventory. So you will now want to focus on the unrealized profit on non-current asset, and also look at overcharge transaction, so overcharge depreciation, and then probably you look at what is loans among the group members, as well as dividends and interest among the group members. Alright, so as stated earlier on, a parent and a subsidiary or more than one subsidiary, so members of the group are not supposed to trade among themselves. Anytime there is an issue like that, then we need an adjustment. Now we want to look at when there is an provision for realized profit for a non-current asset. In this particular question. So a non-current asset, in other words, PP, right? So the same as we did earlier on, the parent can sell to the subsidiary, or the subsidiary sells to the parent an item of a non-current asset. Anytime that happens, we should make sure to eliminate any unrealized profit and overcharge or undercharge depreciation, and we'll look at how to deal with the accounting treatment and the journal entries as well. So first, let's look at how to account for the unrealized profit on the non-current asset. Assuming that P is selling to X. Now, they are selling to X an amount of 6,000. Let's use this example to establish and understand, okay? An amount of 6,000. So P sells to X an amount of 6,000. But the asset originally cost 10,000 with a useful life of 5 years. And this transaction is occurring at the end of year 3. So this transaction is occurring at the end of year 3. Then there is an issue of unrealized profit in there. At the end of year 3, what will be your carried amount of the assets that is being transferred? At the end of year 3, the carried amount is going to be, in fact, our annual depreciation of the assets is going to be the 10,000, which is the cost, divided by the useful life of 5, which is going to give us 2,000 each year. So at the end of year 3, our carried amount is going to be the cost less our accumulated depreciation of 2,000 times 3, which is going to give us 4,000 over a year. Now the carried amount of the assets is 4,000 at the date of the transaction. At the date of the transaction. But look at the amount P has sold the item to X. That means there is an issue of unrealized profit there. So the provision for unrealized profit in that regard is going to be the 6,000 minus the 4,000, which will give us 2,000. So this is the so mostly anytime there is a trading of non-current assets, first you have to determine the carried amount of the asset. So determine the carried amount of the asset on the date on which the asset is being transacted to see whether there is an unrealized profit or there is no realized profit. So in this case, if you compare the carried amount of the asset and it is more than the amount that the item was sold, then there's an issue of what unrealized profit in there. So immediately remember that you debit your group retained earnings, and then you will probably credit your asset account, the asset that you sold. So you credit your asset account with this amount. Remember, if the parent making the sale, then parent bonds all the unrealized profit. But if the subsidiary, we share this particular amount between the parent and the what, and between the parent and then the NCI holding. So here the parent will take some, depending on the percent, let's say 75% over here, and then we still debit the NCI because the subsidiary is the one selling with the 25% of the same unrealized profit. But remember that you will credit your asset with the same value. That is the first treatment when it is a sale of a non-current asset. Now there's another issue here, and this issue is about overcharge or undercharge depreciation when there is a trading of non-current asset among the group members. So if P sells to X at this amount, but the carried amount is 4,000, then there is an issue over here. The annual depreciation when the transaction didn't take place is 2,000. For that matter, is supposed to proceed. Here we were not informed if there is any change in the remaining useful life, so we proceed with that. So after the sale, so after the transfer, what will be our annual depreciation? So our annual depreciation after the transfer is going to be the 6,000, the amount to the item was sold, which is here, divided by the remaining useful life of 2, and this is going to give us an amount of what, 3,000 over here. This 3,000 over here means we have overcharged depreciation. Depreciation was supposed to be 2,000. If the transfer didn't happen, it is supposed to be 2,000, but here we have charged depreciation of what? Of 3,000. So there's an issue there. So the difference of 1,000 depreciation has been what? Has been overcharged. Depreciation was supposed to be 2,000, but we ended up charging what? This amount. This means that this has reduced our profit. And for that matter, if we are preparing the P&L account, you go and add this amount as a gain or as add back to our profit. But if we are preparing the statement of financial position, then there is a need to adjust our group retained earnings. So in our group retained earnings, we are going to credit our group retained earnings, and then we will debit the asset. We will debit the asset account because that particular amount of 1,000 must increase the asset value. So we debit the asset account and then credit group retained earnings. If the depreciation is what? An overcharged depreciation. There can be instances where you have it undercharged. If it's undercharged, then we do the opposite. We will credit the asset and then we will debit the group retained earnings. Remember that this debit simply means that if you go to the statement of financial position and you are taking your PPE, then come and add this amount of 1,000 to the asset, and then less your unrealized profit, which means you have the treatment we had here earlier on. We credit your asset over here. We credit our asset with the unrealized profit of 2,000. That's what I'm bringing here. Instead of using the double entry, this is the same treatment over here. So at the end, you will see the balance over here. The balance here is going to be minus 1,000. That means our asset is going to be reduced by the 1,000, which will be equivalent to what? To the asset it would have been if there was no profit element, or if the asset was sold at the carried amount at the date of the transfer. So please don't be confused with this so many computations or treatments. First, remember to establish the carried amount on the date of the transaction. Now compare the carried amount with the amount the asset was sold. if the carried amount is lesser or the amount the asset was sold to the other member was more than, then there's an issue of unrealized profit. Treat that unrealized profit first. Remember that you will take it to your group account, your group retained earnings as well as a loss, because profit, unrealized profit over there. And that is the case where you are preparing statement of financial position. But if you are preparing the income statement, the consolidated income statement, then this amount will go as an expense in your POL account. In other words, you debit your POL account the same way you are debiting your group retained earnings over here, and then you credit your asset because you have to reduce the asset. Assets have debit balances, so you crediting means that you are reducing the asset like you have seen over here. Then you go ahead to determine whether there is an overcharge depreciation or there's an undercharge depreciation. How do you do that? Now determine the depreciation after the transfer has occurred, as we have done here. After the transfer has occurred, we have now determined the depreciation. It is now 3,000. But when the transfer has not occurred, the depreciation was 2,000. So the depreciation of 3,000 has been overcharged by what? 1,000. This also needs another treatment. Here we are saying that you credit your group retained earnings and then you will debit your assets. In other words, if your asset has debit balances, so if you are debiting, that means you are adding. That's why you can see the 1,000 addition over here. And then the group retained earnings has credit balance, so that means you are crediting. That means you are what? You are adding over here, the 1,000 over here. Is that okay? In other words, this, when you come here, you less the 2,000 and then you add the 1,000. So you see the balance will be negative. The same thing over here is the same thing. There, in some books, they find the net value before they go and do the necessary treatment. You can also do them separately. At the end of the day, the effect will be the same thing in the instead of finding the net before treating it that way. And this will probably give more information about how you are getting that particular value than netting it off and treating the net value. So this is it about also the unrealized profit on non-current assets. Remember, the subsidiary can sell to the parent, and the parent can also sell to the subsidiary. In any way, the treatment will be the same, but just that the unrealized profit must be apportioned between the parent and then the NCI, depending on the amount of holdings each of them has. So the final intra-group tradings activities we would like to, or events we would like to look at, is going to be dividends and interest, and then loans. Dividends and interest, and then loan. So the parent can give the subsidiary loan at the end of the period, and probably the subsidiary is supposed to pay interest on that particular loan. So when you're preparing your group account, remember to eliminate any intra-group transaction. That's the idea. If you're preparing your group account over here, as for the separate financial statement, we'll have that information in there. But when you're preparing your group account, remember to eliminate all intra-group, transactions or trading that exists between the parent and the subsidiary, or more than one subsidiaries or group members. In this case, if P has loaned X or X has loaned P and it is in their separate financial statement, when you're preparing the group account, nothing should count there as such. The same way, if you have dividends that is being paid to any of them in their separate financial statement, and then you're preparing your group account, either income statement, the statement of financial position, or the cash flow statement, remember to eliminate these dividends and then the loan in your group account, unless otherwise stated, or you have some exceptions to it. So remember that dividend or interest or loan that a member owns to another member in the same group must be eliminated. This is how you deal with this one. It's as simple as that. So remember that in this we look at indebtedness, we look at goods in transit and cash in transit. We also look at the unrealized profit when it comes to inventory, how to determine it and how to account for it. We also look at unrealized profit when it comes to a non-current asset, as well as the treatment, and then how to determine the unrealized profit as well as the undercharge or overcharge depreciation. So we will probably be taking, in fact we are mostly done with most of the adjustments. So in our subsequent lesson, we will take another full set of questions and look at how to adjust or how to account for all that we have been learning all this while. So continue to follow or join the lesson as we take you through the consolidation process. So in our next lesson, remember we'll be solving a full question to establish our understanding of all that we've learned so far, especially the intra-group trading. Thank you, and thanks for always being part of the learning family.